Is real estate still a good investment? Have you ever looked at property prices and thought, how can anyone afford this anymore? Maybe you've seen an apartment that cost 30 lakh a decade ago and now sells for 80 lakh or more. Or perhaps you've heard someone say, real estate is the safest investment. Land never loses value. But is that really true? Is real estate still a good investment in 2026? Or are high property prices, interest rates, maintenance costs, taxes, and changing lifestyles making real estate less attractive than it used to be? The answer is more complicated than a simple yes or no. Real estate can still be an excellent investment. But buying property blindly just because property always goes up can be a very expensive mistake. So in this video, we are going to take a realistic look at real estate as an investment. We'll discuss how real estate actually makes money, the biggest advantages and disadvantages, rental income, property loans, appreciation, hidden cost, residential versus commercial property, real estate versus stocks, and most importantly, when buying property actually makes financial sense. Let's begin. What makes real estate an investment? At its simplest, real estate investing means buying property with the expectation that it will either generate income, increase in value, or ideally do both. There are several ways real estate can create wealth. The first is capital appreciation. You buy a property for 50 lakh. Years later, if its market value becomes 75 lakhs, you've gained Rs 25 lakh in value. The second is rental income. Instead of simply holding the property, you rent it out and receive monthly income. For example, suppose you purchase an apartment for 60 lakh and rent it for 20,000 per month. That's 2.4 lakh in annual gross rent. The third benefit can come from leverage. This is where things get interesting. Instead of paying the entire 60 lakh yourself, you might pay 15 lakh as a down payment and borrow the remaining 45 lakh through a home loan. If the property later increases significantly in value, your return on your own invested capital can potentially be much higher. But leverage works both ways. If property prices fall while your loan remains outstanding, your losses can also become much larger. And that's something many new investors underestimate. Why do people love real estate? There is a reason real estate has remained one of the world's most popular investments. First, it's tangible. You can see it. You can visit it. You can live in it. You can rent it out. Unlike a stock which exists electronically, property feels like something you actually own. Second, real estate can generate regular cash flow. A good rental property can provide monthly income for years. Third, property can potentially protect purchasing power over long periods because rents and property prices may rise as the economy and incomes grow. And fourth, real estate can be purchased with borrowed money. That's leverage. Imagine two investors. Investor A has 20 lakh and invests it entirely in an asset. Investor B also has 20 lakh but uses it as a down payment to control a 1 crore property. If that property rises substantially in value, Investor B's return on their original 20 lakh could be much larger. But remember the other side of the equation. The bank still expects its money. The EMI doesn't disappear just because property prices fall. That's why leverage can be powerful but dangerous. The biggest problem with real estate. Now let's talk about something that property advertisements rarely emphasize. Real estate is expensive to buy and expensive to sell. When you purchase property, the headline price isn't necessarily the total amount you spend. Depending on the location and transaction, there can be registration charges, stamp duty, brokerage, legal expenses, taxes, renovation costs, furnishing expenses, maintenance charges, society fees, insurance, and financing costs. And when you sell, you may again face brokerage, taxes, legal expenses, and other transaction costs. This creates an important difference between real estate and many financial assets. You cannot usually buy and sell property with a single click. Real estate is relatively illiquid. If you suddenly need money tomorrow, selling a house at the price you want may not be possible. You may need weeks or months, and if the market is weak, you may have to reduce your price. That's why an emergency fund is especially important for property investors. Does real estate always go up? This is one of the biggest myths. People often say, "So, property prices never fall." That's simply not true. Real estate markets can experience corrections, stagnation, and declines. And even when the nominal price of a property doesn't fall much, the investment can still perform poorly after adjusting for inflation, taxes, maintenance, and other costs. Let's say your property value increases by 5% per year. That sounds good. But if inflation is also high and you have substantial maintenance expenses, taxes, interest costs, and transaction costs, your actual investment return may be much lower than you expected. This is why investors should focus on total return, not just the property's selling price. Rental yield. The number you should know. If you're buying property as an investment, one of the most important numbers is rental yield. The basic calculation is ARJA, annual rent, property value x at 100. For example, suppose a property costs 80 lakh and generates 25,000 per month in rent. That's 3 lakh per year. Rs 3 lakh divided by 80 lakh equals a gross rental yield of about 3.75%. But that's before expenses. After maintenance, vacancy, repairs, taxes, property management, and other costs, your actual net yield could be lower. This is where many investors make a mistake. They look at 25,000 of monthly rent and think, I'm earning 25,000 every month. But the real question is, how much money do I actually keep after every expense? That's the number that matters. The EMI trap. Now let's talk about home loans. Suppose you buy a 1 crore property with a large mortgage. The property may appreciate over time, but that doesn't mean your investment is automatically profitable. You have to account for the interest paid to the lender. A long-term home loan can result in substantial total interest payments. And during the early years of a typical loan, a significant portion of each EMI goes toward interest rather than reducing the principal. This doesn't make home loans bad. Loans can be useful financial tools, but investors need to understand the difference between the property is appreciating and I'm making a good return on my actual investment after financing costs. Those are not the same thing. What about buying a home to live in? This is an important distinction. An investment property and your primary residence are not exactly the same financial decision. When you buy a home to live in, you're getting something beyond financial return. You're getting a place to live. You're gaining stability. You don't have to worry about a landlord asking you to move. You can customize the property. And you may value living in a particular neighborhood because of schools, work, family, transportation, or lifestyle. So the decision to buy your own home shouldn't always be judged purely through the lens of investment returns. For many people, a home is both an asset and a lifestyle decision. The danger comes when people convince themselves that every expensive home purchase is automatically a brilliant investment. Sometimes the best financial decision may be renting and investing the difference elsewhere. Rent or buy? This is one of the biggest questions in personal finance. Should you rent or should you buy? There isn't one answer for everyone. Buying can make sense if you plan to stay in the same location for a long time, have a stable income, can comfortably afford the EMI, have enough money for the down payment and additional costs, and the property is reasonably priced relative to local rents. Renting can make sense if you expect to move frequently, your career or locations is uncertain, property prices are extremely high compared with rents, or buying would consume most of your savings. Here's a simple way to think about it. Don't ask, can I get a home loan? Ask, can I comfortably own this home without damaging the rest of my financial life? Those are very different questions. The hidden cost of owning property. Imagine you buy an apartment. The EMI is 50,000. You might think, that's my monthly housing cost. Not necessarily. You may also have maintenance charges, property taxes, repairs, appliance replacement, painting, insurance, society expenses, brokerage when you eventually rent or sell, and sometimes unexpected expenses. A property can look profitable on paper while quietly consuming cash every month. This is especially important for investment properties. If the rent is 30,000, but your total monthly ownership cost is 45,000, you're effectively subsidizing the property. That might still be a good strategy if you have strong reasons to expect future appreciation, but you should know that you're doing it. Residential versus commercial real estate. Not all real estate is the same. Residential property is usually easier for ordinary investors to understand. You buy a house or apartment and rent it to a family or individual. Commercial property is different. It can include offices, shops, warehouses, and other business spaces. Commercial property may potentially provide higher rental yields, but it can also involve greater complexity, larger investment amounts, tenant risk, vacancies, and location-specific challenges. For example, a commercial property in a strong business district may have excellent rental demand, but a property in a weak location could remain vacant for a long time. So once again, the location matters enormously. Location is still king. You've probably heard the phrase, location, location, location. It sounds like a cliche, but there is a reason it has survived for generations. You can renovate a house, you can repaint it, you can upgrade the kitchen, you can replace the flooring, but you can't move the land. A property near strong employment centers, transportation infrastructure, schools, hospitals, shopping areas, and other important facilities may have stronger long-term demand. But investors should be careful with future infrastructure promises. A brochure saying, future metro station coming soon, doesn't guarantee that the project will arrive on time, or even that it will have the expected impact on property prices. Do your own research. Real estate versus stocks. Now comes the comparison investors often debate. Real estate or the stock market? Stocks have several advantages. They are highly liquid. You can start with relatively small amounts. You can diversify across hundreds or thousands of companies through funds. Transaction costs can be low, and you don't need to manage a physical building. Real estate has different advantages. It is tangible. It can generate rental income. It can potentially be purchased with leverage. And some investors are more comfortable understanding physical property than financial markets. But there is one major misconception. People sometimes compare the purchase price of a property with the stock market return without accounting for all the costs of owning the property. A proper comparison should include purchase costs, loan interest, maintenance, taxes, vacancy, rental income, appreciation, selling costs, inflation, and the opportunity cost of the money invested. Only then can you make a fair comparison. Is real estate safer than stocks? Not automatically. Real estate often appears less volatile because property prices aren't displayed every second. Imagine owning a house worth 80 lakh. You don't receive a notification every 5 minutes saying, your house is now worth 79.5 lakh. But if you owned a stock portfolio worth 80 lakhs, you might see its value changing every minute. That visibility can make stocks feel more volatile. But the underlying economic risk still exists in both markets. A property can lose value, a tenant can leave, a neighborhood can decline, a project can be delayed, interest rates can rise, and a highly leveraged investor can face serious financial pressure. So instead of asking which asset is safe, ask, what risks am I taking and can I afford them? Can real estate make you rich? Yes, but usually not because someone bought a random apartment and waited. Successful real estate investing often involves some combination of A, buying at a reasonable price, choosing strong locations, understanding rental demand, using debt responsibly, holding for the long term, managing expenses, and having enough financial flexibility to survive difficult periods. The biggest advantage of real estate can be time. A good property held for 10, 15, or 20 years may benefit from economic growth, population growth, infrastructure development, rising incomes, and increasing demand. But time cannot fix a fundamentally bad investment. If you overpay for a property in a weak location, waiting longer doesn't automatically make it a good investment. When real estate may be a good investment, real estate may make sense when several conditions come together. You have stable income, you have an emergency fund, you aren't drowning in expensive debt, you can afford the down payment without using every rupee of your savings. The EMI is comfortably manageable. The property has strong fundamentals. Rental demand is healthy if you're buying for investment. The purchase price is reasonable and you're prepared to hold for the long term. Notice something important. The property itself is only one part of the decision. Your personal financial situation matters just as much, when you should probably avoid buying. On the other hand, buying property may be a bad idea if you're stretching your finances just to qualify for a large loan, if the EMI would consume most of your income, if you have no emergency savings, if you're already carrying expensive debt, if you're buying purely because everyone around you is buying, or if you're assuming that prices will rise quickly. That's not investing. That's speculation. And speculation becomes especially dangerous when it's financed with debt. A better way to think about real estate. Instead of asking Jenta, will property prices go up? Ask 5 better questions. Number 1, how much will this property actually cost me? Not just the purchase price, everything. Number 2, what is my expected net rental yield? Not gross rent. Net income? Number 3, what is the realistic appreciation potential? Not what the salesperson promises. Number 4, how much debt am I taking on? And can I comfortably handle it if my income falls? And number 5, what is my opportunity cost? If you invest 30 lakhs into a property, what other opportunities are you giving up? Could that money be diversified across stocks, bonds, mutual funds, or other assets? There is no universally correct answer, but asking these questions can prevent emotional decisions. Don't put everything into one property. Another important principle is diversification. Imagine someone has 1 crore of total wealth. They put Rs 90 lakh into one apartment. That means most of their financial future depends on one asset in one location, possibly with one tenant profile and one local market. That's concentration risk. A diversified portfolio can spread risk across different assets. Real estate can absolutely have a place in a diversified portfolio, but it doesn't necessarily need to be the entire portfolio. What about REITs? And this is where things get interesting. If you like the idea of real estate, but don't want to buy an entire building or apartment, you can look into real estate investment trusts, commonly known as REITs. REITs allow investors to participate in portfolios of income-generating real estate through publicly traded securities. Instead of buying one physical property yourself, you can gain exposure to a broader pool of real estate assets. One advantage is liquidity. You can generally buy and sell listed REIT units through the market, unlike a physical property. But REITs have their own risks. Their market prices can fluctuate. Interest rates can affect them. Property occupancy can change. And their performance depends on the underlying assets and management. So REITs aren't a risk-free replacement for physical property. They're simply another way to get real estate exposure. The biggest mistake investors make. Perhaps the biggest mistake is confusing a good asset with a good price. A beautiful apartment can be a terrible investment if you pay too much. A great commercial location can still produce poor returns if the purchase price is unrealistic. And a modest property bought at the right price can sometimes outperform a luxury property. The goal isn't to own the most expensive property. The goal is to make a sensible investment. So, is real estate still a good investment in 2026? Now let's answer the original question. Yes, real estate can still be a good investment in 2026, but it isn't automatically a good investment. The era of simply buying any property and assuming it will make you rich is not a strategy. Modern real estate investing requires numbers. You need to understand the purchase price, the rental yield, the financing cost, the taxes, the maintenance, the vacancy risk, the location, the demand, and your own financial situation. For some investors, property may be an excellent long-term wealth-building asset. For others, buying an expensive home with a huge EMI could become a financial burden. And for some people, renting while investing elsewhere may actually be the better choice. The right answer depends on the person, the property, the price, and the numbers. Final thoughts: real estate has survived as an investment for generations. Because land is scarce, people need places to live and work, and well-located property can produce both income and long-term value. But real estate isn't magic. It doesn't guarantee profits. It isn't automatically safer than stocks. And property always goes up is not an investment strategy. The smartest approach is to treat property like a business decision. Run the numbers. Calculate the real costs. Understand the debt. Research the location. Think about your cash flow. And never buy a property simply because someone tells you. You have to buy now, otherwise you'll miss out. Because FOMO is not a financial strategy. If the numbers make sense, real estate can be a powerful part of a long-term wealth-building plan. If the numbers don't make sense, walking away can be the best investment decision you make. And remember this simple rule: don't buy property because you hope it will become valuable. Buy it when the price, income potential, location, financing, and your personal finances all make sense. If you found this video useful, subscribe to the channel for more practical videos about money, investing, wealth building, and personal finance. And in the comments, tell me, Veki, would you rather invest in physical real estate, or REITs, or the stock market, and why? Thanks for watching, and I'll see you in the next video. Disclaimer: this video is for educational and informational purposes only. It is not financial, investment, tax, legal, or real estate advice. Property prices, rental income, interest rates, taxes, regulations, and investment returns can vary significantly by location and individual circumstances. Always conduct your own research and consider consulting a qualified financial or real estate professional before making investment decisions.